Think you need to be the next Warren Buffett in order to build wealth? Spoiler alert, you're wrong. Imagine a portfolio so simple that you don't have to pick the right stocks, time the market, or chase the latest trends. Well, in today's episode, I'm going to show you how you can set up a 3-fund portfolio. Yep, that's right. I am pulling back the curtain on my own investing philosophy and portfolio to show you how you can set it and almost forget it. Let's go.
Welcome to your Money on Easy mode with Damien.
When I first started investing, I thought that I had to pick the right stocks. I thought the path to wealth through stock market investing was reading through earnings reports, listening to the talking heads, and finding the next hot thing. All of this research and time spent left me stressed out and not making big gains. Luckily, after a lot of research, I stumbled on the simplest path to wealth, which is what I'm going to show you today. In this episode, we're diving deep into my investment philosophy, how I focus on diversification, cutting costs, and keeping things simple in order to gain about 10% every year. Whether you're a beginner or just looking to refine your strategy, you're going to walk away today with tips to help you build a portfolio that works a lot harder than you do. So let's start out with some of the stock investing basics. First up, picking stocks is the wrong way to go. I know picking individual stocks sounds exciting. The idea of picking the next winner and beating the stock market and making huge returns is tempting. But here's the reality. Even professional fund managers can't beat the market over several years. It is statistically nearly impossible for professional stock pickers to consistently outperform the stock market. Predicting which companies will thrive and doing this repeatedly is incredibly difficult even for the professionals. When you try to pick the right winners and you focus on a small number of stocks, you're exposing yourself to what's called concentration risk. Think of it this way. You're picking very few eggs and putting them all into one basket. So if one of those stocks performs poorly, it can wipe out almost your entire portfolio. The solution to the problem of trying to pick the winners and being concentrated in a small pool of stocks is the concept of diversification. Diversification simply means that you are investing a little bit in a lot of different stocks. By spreading your investment over a bunch of different companies and even industries, you're spreading out the risk and reducing the likelihood that having picked one big loser is going to wipe out your entire portfolio. Now, the really good news about diversification in today's world is that there are simple ways for us to diversify our stock portfolio. Those are through mutual funds. A mutual fund is one stock that you pick that contains a basket of many different stocks and companies. A particular type of mutual fund that I invest in and that I'm going to recommend to you today is what's called an index fund. An index fund tracks a group or an index of stocks instead of trying to pick the best winners. One big example of an index fund is what's called the S&P 500. The S&P or Standard & Poor 500 are the top largest 500 companies that make up the stock market. By investing in one S&P 500 fund, you're actually investing in 500 different stocks. So the beauty of an index fund is that it's well diversified for you and you're not trying to pick winners or losers. You're invested in a basket of stocks spread out across many different industries. Jack Bogle, the founder of Vanguard, had a saying. He said, "Instead of trying to find the needle in the haystack, just buy the entire haystack." I love this thought. Instead of us trying to spend time, money, and stress trying to pick the winners and beat the stock market, just be the stock market. By investing in a broadly diversified index fund, you are the stock market instead of trying to beat the stock market. So that was investment philosophy number 1, diversification. Instead of trying to pick the winners, invest in a broad basket of stocks, and your fortunes rise and fall with the entire stock market. Investment philosophy number 2 is to control for the one thing that we can, and that is costs. We cannot control which direction the stock market will go, but we can control how much money we spend to be able to invest. Investment fees can eat into a huge chunk of your investments. So how can we make sure that we're paying the lowest fees possible? One thing to avoid are what are called actively managed funds. That means that a person, a stock investment pro, is picking the stocks that go into your fund. Whenever a human's involved in picking the stocks, the fees are going to skyrocket. To give you a ballpark idea, some of these funds have fees around 1% of your investment. Now, when we get to my examples of the exact funds that I recommend to invest in, you'll see that the fees are a fraction of 1%, 3% of 1%, but I'm getting ahead of myself. So avoid actively managed funds because they have a lot higher fees, and that increased fee does not equate to a higher return. So if we stick to index funds, they have rock bottom fees and they have the return of the stock market, which is on average 10% year over year. Here's a really fun chart from one of my favorite investment forums, boggleheads.org, that shows the cost of fees compounded over 40 years. Here's how to look at this graph. Imagine that after 40 years, your stock portfolio has grown by $250,000. Take a look at how much money you would be paying to your advisor based on various fees that they charge you. A very common fee that advisors charge is 1% per year. That's the middle graph here. You can see that if they charge 1% per year, out of that $250,000 that your investment portfolio grew by, you only take home $160,000 worth of it. The rest of it goes to your advisor. Now zoom all the way over to the left-hand chart. If the fee is 0.1%, then you take home almost all of that $250,000. Now, to give you a spoiler for the next section, the funds that I recommend have fees that are well under 0.1%. In fact, they are between 0.03% and 0.05%. So you can see that after 40 years, an investment gain of $250,000, there's a difference of about $100,000 in the fees when you pay an active manager versus when you invest in an index fund. Okay, so we've covered two big areas of my investment philosophy. The first one is to be diversified so that you spread out the risk of your portfolio. The second one is to invest in index funds because they have lower fees. So in both cases, we're avoiding actively managed funds and investing in index funds. Now let's talk about another facet of my investment philosophy, and that is the role that bonds play in your investment portfolio. When most people think about investment and investing portfolios, they think about stocks. As we know, when you own a stock, you own a small part of a company. Bonds, on the other hand, are another way to invest that is actually investing in the debt of companies or of governments. When you invest in bonds, you are loaning money to companies or to the government. Bonds have lower rates of return, but they're also less volatile, less risky. So by adding bonds into your investment portfolio, you smooth out the growth and loss to give you a smoother glide path towards your investment goals. Bonds reduce risk and they can give you more peace of mind in your investment portfolio. So how much of your investment portfolio should be in stocks versus bonds? This is a personal preference, and it's based on your risk tolerance. If you are younger and have 30 or 40 years in your investment horizon, then I would recommend very little being invested in bonds. If you are near retirement and looking to start spending your investment portfolio soon, then most of your investment portfolio should be in bonds. Me, personally, I have a higher risk tolerance and a longer time horizon until I need the money, so I only have about 5% of my portfolio invested in bonds. I have a higher risk tolerance than most people, so you may not want to be as aggressive as I am. One of my favorite investing forums, the Boggleheads, they recommend that your age should be your percentage in bonds. So me being 40 years old, they recommend that 40% of my investment portfolio is bonds and 60% is stocks. Like I said, that's a lot more conservative than I am personally, so make your own decisions, but make sure that whatever decision you make, you're able to sleep comfortably at night and you're not worried about your investment portfolio performance. Okay, so how do we put these principles into place? This is the part of the episode where I tell you exactly what I invest in and I recommend for most people. That's what we call a 3-fund portfolio. In order to be diversified and have super low costs, I recommend investing in just 3 funds. Let's talk about those. The first one, and the biggest part of my investment portfolio, is a total domestic or total US stock market fund. The US Total Stock Market Fund invests in every company that's listed on the stock exchange. Next up, I also want to invest in non-US companies, and I do that with a total international stock market fund. So this takes all of the companies that are listed on international exchanges and invests in those. And then finally, I invest in a total bond market fund. This fund invests in corporate debt as well as government debt. With just these 3 investments, you're covering virtually every corner possible of the investment market while minimizing costs and spreading out the risk. This simple set it and almost forget it approach keeps your life stress-free, your investments growing, and it eliminates the need for you to constantly tinker with your investment portfolio. All right, now that we covered the basics of the 3-fund portfolio, let's dive into the details of each of those 3 funds. And we'll start out with the biggest chunk of the investment portfolio, which is VTI, the Total US Stock Market Fund. I personally invest about 70% of my portfolio in the Total US Stock Market Fund. Over time, the US Stock Market Fund has outperformed the international fund, so I have a higher percentage of my portfolio in the Total US Stock Market Fund. When you're buying the Total US Stock Market Fund, you're buying a piece of every company in the United States that's listed on the stock market exchange. The proportion of how much you own in each company is equal to the size of those companies as listed on the exchanges. So in VTI's case, here are the top companies that you're investing in. Many of these companies will look familiar. Of course, there's Apple, Microsoft, Amazon, the chip maker NVIDIA, and then the parent company of Google, which is Alphabet. All common household names. These are mega companies with huge market caps. So by investing in VTI, you're getting access to these major players as well as thousands of other smaller companies that do business in the United States and have the potential to grow. Here we are on Vanguard's website with information about the Vanguard Total Stock Market Fund. This is what's known as an ETF, an exchange-traded fund. That isn't too important. Just know that exchange-traded funds can be traded throughout the day rather than just at market close, which is the case with mutual funds, but not really a detail that's important to us today. Here's what I wanted to point out. Look at this expense ratio, 0.03%. That's insane. $100,000 invested in this fund, you pay $30 per year for that investment. That's an insanely low expense ratio. Let's see, here is the performance over time. So the 5-year return has been 16%. The 10-year return has been about 12%. So that is a very healthy return for your investments. And over a 20 to 30 year time horizon, you're going to have plenty of money for retirement. So that was VTI, the total US stock market fund. Let's take a look at the second biggest piece of my investment portfolio, which is VXUS. This is Vanguard's total international stock market fund. So like I said, this is invested in the big companies and the small players who are not based in the United States. Here are examples of some of those companies. Nestle, the big chocolate maker. Toyota, the car maker. Samsung, the electronics maker. These are companies that you've heard of. They make a lot of money every year. So I said before that I have about 70% of my portfolio invested in the total US stock market fund. I've got about 25% of my portfolio invested in the total international stock market fund. So that takes us up to 95% of my total portfolio is split up between the total US and the total international funds. Taking a look at the Vanguard page for the total international stock market ETF, you can see that the expense ratio for this one is a tiny bit higher, 0.05% rather than 3%. It takes a little bit more work for them to build this index fund in order to invest in all of those international companies. But once again, this is a rock bottom fee. $100,000 invested in this fund is going to cost you $50 per year. And as you can see, the performance is not as impressive over the past 5 and 10 years as the total US stock market fund. This is a point that isn't lost on me. I know lots of people who just avoid the international stock market altogether and concentrate solely on the US stock market. That's fine. I don't have any issues with that if you choose to just invest in the US stock market fund, but I like to be as diversified as possible just in case those non-US companies take off one day. Okay, let's take a look at the last piece of my investment portfolio, that last 5% that I invest into bonds rather than stocks. Just a reminder, a lot of people are more conservative than me and invest more than 5% of their portfolio into bonds. And a reminder that bonds are investments in debt rather than investments in equity, which are stocks. So I invest in the Vanguard BND Total Bond Fund. This is spread out between US Treasuries, housing, and US government debt structures, and then also corporate bonds. So you are investing in a little bit of private debt in addition to all of the US government debt that you're investing in. And remember that bonds, they give you less of a yield than stocks do, but they're also more predictable than stocks. So looking at BND, which is the Vanguard Total Bond Market ETF, the expense ratio is the same as VTI, 0.03%. And taking a look at the performance, we can see the 10-year return is just 1.5%. So the returns are nowhere close to what you get with stocks. However, they are more consistent and they smooth out your gain and loss curve. All right, there you have it, a full breakdown of my personal investment philosophy and the exact funds that I invest in. Now remember, I have to say this for the lawyer's sake, this is not investment advice. This is for entertainment purposes only. I'm just letting you know how I invest. You do your own research and make your own decisions. Here's why I invest in the 3-fund portfolio. First, diversification. Instead of me trying to pick the stocks that are going to beat the market, I become the market. Instead of trying to pick the needle out of the haystack, I buy the whole haystack. By diversifying your investments, you reduce your risks and your stress level. Second, control the things that are in my control, which are the costs. By investing in index funds with reputable places like Vanguard, I pay the least amount possible for the same return or better than what I would get with actively managed funds. So, with those two philosophies in mind, I have a 3-fund portfolio that invests in a total US stock market fund, a total international stock market fund, and a total bond fund in order to give me that diversification and those rock bottom fees. I hope this information has been useful for you. Please do your homework, figure out your own investment philosophy, and let me know in the comments if this information was useful for you. See ya!
Thanks for listening to Your Money on Easy Mode. If you enjoyed this episode, then please subscribe and share it with a friend.